silver's going to move a lot. We can have an argument, is that really physical? Is it loading out? Is it just whatever? Is it just a warrant? It's more physical than this, which is nothing. Silver open interest threatens to break below 100,000 contracts. You can see here, this is the latest numbers for April 28th, and we are at 101,400 contracts. This is extraordinarily low. We have not been below 100,000 since the great financial crisis of 2008. The dearth of physical silver in London is forcing open interest lower. And so if open interest has to get higher because other people want to go long in New York, then they're going to have to mark up prices in order to encourage commercial firms to go short the metal. And they're going to need more metal in London, and it's going to cost more money. So the price of the silver is going to go up in order to support all of those short positions to be hedged in London. The share of US dollar holdings decreased to 56.77% in 2025 Q4. So if we just go back a little bit, 56.77%, that's slightly lower than where we are now. But what is contributing to that decline since 2021? Share of euro holdings decreased. And here's proof that I was going to show you that the silver bullet is physical and 2011 was paper. This is a very stark chart. You can see here, I drew all these wonderful little rectangles that I learned how to do in art class. And this shows the amount of deliveries, contract deliveries, going back 2006 as far as we have data. So we can see that in 2011, right when silver was approaching 50, right? This is that little spike that used to look really big until we got to this big spike over here, 120 in 2025, 2026. Whoa. So when silver was hitting 50, what was happening to deliveries? All-time low. Almost an all-time low for the data that we have. This is very, very anemic amount of deliveries. There was no deliveries happening. That's proof that the previous run to 50 in 2011 was all speculative paper nonsense. And here we have this other rectangle at the end of 2020 when there was a spike in silver after the big COVID printing bonanza craziness. We had a record number of contracts, about 16,500 contracts of silver. Multiply that by 5,000 to get the amount of ounces, and that did cause a spike in the price from about $11 to about 35, 36, something like that. And we see here that we had a huge amount of persistent deliveries from 2025 all year, like near this record over here in 2020 that was hit for only 1 month, but persistent, huge amounts of physical deliveries of contracts.
If physical silver deliveries are truly driving price, the old paper narrative collapses faster than most investors realize. As Rafi Farber points out here, 2011's $50 silver peak aligned with near zero deliveries, while recent cycles show sustained physical drawdowns. The disconnect reframes rallies as liquidity events rather than pure sentiment spikes. For investors, it signals silver price swings may intensify as physical stress builds. Next, Rafi Farber reveals how sub 100,000 open interest levels historically preceded major silver inflection points.
And okay, we can have an argument, is that really physical? Is it loading out? Is it just whatever? Is it just a warrant? Okay, but it's more physical than this, which is nothing. We continue to see that elevated amount of deliveries here, and this spike has a lot to do with the fact that the deliveries on these little peaks over here are very, very high. So yes, we are in a physical demand market as opposed to 2011 when we were not. Silver open interest threatens to break below 100,000 contracts. You can see here, this is the latest numbers for yesterday, April 28th. And we are at 101,400 contracts. This is extraordinarily low. We have not been below 100,000 since the great financial crisis of 2008. And we have about 8,817 contracts left to either roll over or close out before May delivery deadline tonight, April 29th. So we have 8,817 contracts that potentially are going to be closed out. Probably going to be a little less than that because some of them are going to roll over. But is it going to be more than 1,400? Break the 100,000 mark? It's probably going to be more than that. And then more are going to close out when they're delivered as May continues. So we could get a low below 100,000 contracts as May begins, let's say May 2nd, May 3rd, May 4th. If we get to about 80, 90,000 contracts, I'm going to make some moves in silver.
Would you teach me some moves?
And I'll show you why that is.
A silent drop toward 100,000 open interest signals stress before price even moves. As Rafi Farber points out here, falling levels near 101,400 alongside 8,800 expiring contracts suggest positioning pressure building under stable headlines. We have not seen sub 100,000 readings since 2008, making this structurally sensitive. For investors, this creates binary risk as delivery pressure could accelerate volatility into May expiration. Next, Rafi Farber exposes how rollovers versus forced closes may distort the true physical signal.
Because you can see here, the last time we were below 100,000 contracts in open interest, you can see the green area is open interest, and we broke below it here, and that was precisely where the major low in silver was at the end of 2008 at about $10. I think it was like $8.50. And from there, about a 2.5 year move up to 50. It's not going to take that long this time because things are going a lot faster now. And this move to we're at 100. We're about 100,000 now. So this is where we are now. Imagine the green over here. Silver is going to move a lot, I think, when open interest goes back up and the speculative fervor increases. And if you want to know what I'm going to be doing if we do get to 90,000, 85,000 contracts, somewhere in that area, I'm going to be working with some options, and it should be fun. So check out the Endgame Investor on Substack for that if you want to know. Does paper really suppress price? Well, you could look at this chart and say, yes, the green is open interest. So you can see in this triangle, this is the trend line for open interest from the 2011 top at 50 to the 2020 bottom at about 11 during the lockdowns. So as open interest trended higher and higher and higher and higher, price trended lower and lower and lower and lower. So you could say that paper is being dumped on the market and manipulating the price lower. Fine. It's an argument you could make.
Every breakdown below 100,000 open interest has historically aligned with major silver cycle pivots. As Rafi Farber points out here, the 2008 drop near $8.50 preceded a rapid move toward $50 in compressed time. The timing compression suggests modern cycles may accelerate under liquidity-driven futures positioning. For portfolios, that means entry points near open interest lows often precede the steepest moves. Next, Rafi Farber unravels why today's decline may mirror 2008, but unfold at faster velocity.
I don't believe it, but you also see the opposite. Over here, the price trends higher and higher and higher and higher. Here's the top in January 29th. As open interest trended lower and lower and lower and lower, we're at 100,000 contracts now. It's not perfectly correlated, but it is a general pattern that we see here. And there's a lot of ups and downs and what have yous and ins and outs and all that stuff.
A lot of ins, a lot of outs, a lot of what have yous.
What do I think is actually happening here? What I think is actually happening here is that most of these open interest contracts are hedged with physical supply in London. And now, since the physical supply in London is so low, that means that they can't hedge with physical supply in London, so open interest goes down, at least for the commercials, which account for most of the open interest anyway. So I think the dearth of physical silver in London is forcing open interest lower. And so if open interest has to get higher because other people want to go low, going to go long in New York, then they're going to have to mark up prices in order to encourage commercial firms to go short the metal. And they're going to need more metal in London, and it's going to cost more money. So the price of the silver is going to go up in order to support all of those short positions to be hedged in London. So it's a cart before the horse before the cart kind of thing, chicken and egg. It's a chicken and egg argument.
It's like the chicken and the egg. Will, the chicken and the egg. We think it started in the past, but it didn't. It started right here.
The whole thing is really just a chicken and egg argument. It's not worth getting all worked up over. Whatever is happening, and either way, silver's going to go up, whatever you think is actually happening.
What looks like normal hedging may actually signal a breakdown in global silver liquidity coordination. As Rafi Farber points out here, shrinking London physical supply is forcing commercials to reduce hedged exposure on COMEX. That shift explains why price and open interest no longer move in clean inverse correlation. For investors, it means structural supply constraints may matter more than macro narratives or Fed policy noise. Next, Rafi Farber exposes the hidden feedback loop between London shortages and COMEX positioning pressure.
Okay, so this is a chart that I jiggered in 2021. It's kind of old, but I will connect it with current data in a second, of the dollar's reserve currency status. How many, what the percentage of dollar claims are there relative to all other currencies in the world? So in 2000, the dollar was at its peak strength, and you saw about a 72% dollar share of reserves in 2000, 2001, and that has been steadily declining. It went up a little bit in 2015, 2016 to above 65%, and it went down to below 60% for the first time in 2021. So you might think that the dollar reserve currency status is dwindling, and this chart does seem to show that. However, is the dollar really losing reserve status? This is from the latest counting of COFR. I don't know what that stands for, but it's from the IMF, and they calculate all these claims of all currencies and what percentage of what. So this is from their website, imf.com/COFR, I believe. And we can just read it straight out and you'll see what's happening here. The share of US dollar holdings decreased to 56.77% in 2025 Q4. So if we just go back a little bit, 56.77%, that's slightly lower than where we are now. But what is contributing to that decline since 2021? Well, let's look at it. The share of euro holdings decreased to 20.25% in 2025 from 20.36% in 2025. It's not the euro. That's steady. The share of Chinese renminbi holdings increased to 1.95% in 2025 from 1.92% in the previous quarter.
A 72% reserve currency dominance quietly slipping to 56% sounds like controlled erosion, not collapse. Yet markets are behaving like nothing is changing. As Rafi Farber points out here, the real shift isn't in headline currencies like the euro or yen, but in fragmented other holdings no one can properly track. That raises a hard question. If major currencies are stable, why is the dollar still losing share? For investors, this suggests hidden diversification away from dollar systems is already underway, slowly weakening long-term currency confidence. Next, Rafi Farber reveals why the unidentified currency category may be the most important signal no one is pricing in.
They're still stuck below 2%, the Chinese renminbi. It's nowhere near a reserve currency. It is almost negligible. The share of other currencies individually identified in COFR, including the Japanese yen, pound sterling, Australian dollar, Canadian dollar, Swiss franc, all together, those are all, I think, parts of the dollar index. Those are the major currencies of the world. Edged down. The rest of them edged down to 14.9% in 2025 from 15.18% in the previous quarter. The previous quarter. So it's none of these things, none of them. So what is causing the decline? Meanwhile, the residual other currencies category, covering currencies not separately identified in COFR, increased to 6.13% in 2025 from 5.61% in 2025 Q3. Though still small in absolute terms, the share of unidentified other currencies began increasing in 2021. That's exactly when this chart left off, and has since more than doubled. Okay, so what is causing the continued decline from here is none of the major currencies. It's unidentified currencies, so small in percentage that they're not even named by the IMF, and I can't find data anywhere. Shares of other currencies up 5.14 to 6.13. So everything's basically stable except for other currencies, which since 2021 have doubled up to 6.13. That is what is eroding the dollar's currency status, reserve currency status. That other currencies that aren't even mentioned here, that are too small to mention individually, they're the ones that are building. That's not credible.
A growing 6.13% unidentified currency bucket in global reserves signals fragmentation that official narratives cannot fully classify. As Rafi Farber points out here, major currencies remain flat, yet the system still loses dollar share through opaque categories no one clearly tracks. That raises the uncomfortable possibility that reserve diversification is happening outside traditional reporting structures. For investors, this creates blind spot risk where capital shifts occur before policymakers or markets can react. Next, Rafi Farber exposes how statistical opacity itself may be masking the real currency transition already in motion.
No, the dollar is the reserve currency, and that's not going to change. What is going to change is that the dollar is going to die, and then from that, all other currencies are going to die with it, and then we won't be left with any currencies, and we'll just have money for a while. And that's going to cause a dark age, but it's also going to cause a severe amount of financial honesty. Is going to break out in song and dance and waves, and we're all going to have a kumbaya moment with a lot of starvation, unfortunately.
Extreme binary outcomes in currency systems usually signal emotional framing more than probability, yet they still matter for positioning risk. As Rafi Farber points out here, the discussion shifts from gradual dollar erosion to total systemic collapse, which markets almost never price correctly until stress appears. That kind of framing, even if exaggerated, reflects underlying anxiety about debt saturation and monetary trust. For savers and metals holders, it reinforces the importance of diversification before volatility forces reactive decisions.